The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A great day for stocks, a volatile day for bonds, and a historic day for North American politics. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele, but we're fading here as we get into the close from the highs of the session.
What's happening to our rally?
I don't know.
Yeah.
Fading into the close is never necessarily a good sign for momentum. The S&P is just up by 0.4%. Tech, though, continues to outperform with the NASDAQ up by 0.8%, really helped by semis. But nonetheless, we are definitely off those highs of the session. I did want to point out a big mover here are bond yields. I appreciate it's only up by 2 basis points, but Romaine, we're not that far away from 5%. What does that wind up doing to our equity rally?
Yeah, I think we have to talk a little bit more about the correlation between those two. We talk about the S&P 500, still on pace right now for what could be the best two-day gain in about 2 months, but a lot of caution out there being called for, including from Mike Wilson over at Morgan Stanley, who actually says the stocks have become rate sensitive once again as the 10-year Treasury yield continues to creep toward that 5% level. And he's not alone. Port Garvey over at ING predicting benchmark yields will hit 5.5% toward the end of this year, one of only 3 people among 51 forecasts compiled by Bloomberg that call for rates to end 2025 higher than where they began. That's going to be key. And the move in treasuries today, it has been volatile, as prices started lower but did surge after the Washington Post reported on the potential for Donald Trump to actually scale back his tariff plans to cover only critical imports. We should point out the president-elect quickly took to social media to refute that report, which sent prices back down and yields back up. Now, the tariff drama is a reminder of how important policies in Washington will be to financial markets. That was also made evident in the surprise decision we got by Michael Barr to step down from his post as Fed Vice Chair of Supervision a year and a half before his term expires, primarily to avoid clashes with the new president, who's likely to move in a different direction when it comes to oversight of the financial sector. You're seeing that reflected in the shares of bank stocks today, having a phenomenal day.
A phenomenal day. Citigroup at like a 52-week high. So as Romaine was talking about that relationship between stocks and the bond market. So take a look at this. This is the HS function on your terminal, the historical spread. And I use it to track the correlation between the 10-year yield and the S&P. It's a 30-day correlation. I appreciate it's a short time frame, but it has been a dramatic move. So the blue part estimates that you have yields and equities moving together. Whether up or down, they're moving together. Now here, we're deeply negative at this point. That means that yields and equities are moving inversely of each other. So taking away from that is the higher yields go, then equities go lower. That's one part of this correlation. And this echoes Morgan Stanley, Mike Wilson, that came out with a note over the weekend that says, look, once you had that 10-year yield, Romaine, make a run for the 4.5%, you're going to get some struggle points for equities. And is that what we're actually in store for?
And that is the parlor game on Wall Street right now as we kick you off to the close here on this Monday afternoon. Barry Knapp joins us. He's Director of Research with Ironsides Macroeconomics. And Barry, we do want to start off with these moves in yields. You have a market overall, at least if you look at the swaps and options market, that is actually betting on a drop in yields, at least based on what the Fed might actually do. However, you do have a few outliers out there who are seeing material appreciation in benchmark yields this year, all the way to 5% and maybe even beyond. Who's right?
Well, I think we'll get to 5 before we get to 4. That's for sure. My official forecast was we wind up the year unchanged, but that's highly, meaning around 4.5% on 10s. But that's highly contingent on making progress towards incoming Treasury Secretary Besant's first arrow, which is a 3% budget deficit, which would be a primary surplus. That's a surplus before interest payments. In the short run, there are all these forces pushing the term premium up, right? And that's, you may have seen Torsten Slok's note on New Year's Eve where he said it's the portion of the yield that's attributable to forces beyond just Fed policy expectations. And we've got this giant overhang from the Fed still holding $6.6 trillion of securities. Treasury's been financing the 7% deficits with an excessive amount of Treasury bills. All those things need to be restructured, and all those things are going to push term premium and bond yields higher. So I absolutely agree with Mike. That is the single biggest risk in the first part of the year, and the only thing that could really stop it would be further deterioration in the labor market.
Right, which is really the last thing we want to see, certainly the last thing the Fed wants to see. And I guess that raises the question, Barry, when you look at the moves in equity markets last year and I guess the mini rally that we've had over the last couple of trading sessions, are stock investors more vulnerable to a potential shakeup than maybe what we're seeing in the bond market?
Oh, for sure. It's interesting. I was having a little bit of a wonky conversation with a client earlier today, and he asked me, what's the most extreme thing going on in the equity derivative market? Of course, that was my days at Lehman back in the 90s and early 2000s. And it's this incredibly low correlation within the S&P 500. I mean, it's unprecedentedly low at something like 10%. It would typically be 40 or so, meaning all stocks would tend to move together. And if you just think about that from a simplistic perspective, we had technology and communication services up 40%, and energy and material, who are going to provide the foundation for building out all those Gen AI data centers, at 0% returns for the year. It's very curious, right? So, I think there's parts of the equity market that are really vulnerable to a shock higher in real rates and treasury yields. And maybe we can avoid it. Maybe we get a weak payroll report on Friday. Your economist, Anna Wong, does great work on this. And she thinks the labor market's weak. So do I, the small business portion of it in particular. But to me, that's the only thing that could prevent tens from going back to 5% and causing something of a risk-off shock.
All right, let's go to other asset like the FX market and the dollar, because talk about being on a tear. And the dollar has really outperformed. I mean, just look at the pain we've seen in the euro and the yen, for example. At what point does that start to hurt the equity market?
Yeah, that's a big issue, too. I wrote a note in early December after the election, our dollar, everyone's problem. And, the Chinese stopped supporting the yuan at 730 last week, and it is moving towards an all-time high that it hit back in October of 22 when we were at the maximum point of Fed policy tightening. A move to 750 or so is what's actually in most people's forecasts, but if it happens quickly, that could be disruptive. The euro going through parity could be disruptive. The yen going to a 50-year high above 161 or so. Again, all those things are indicative of tighter financial conditions and could cause reverberations throughout global capital market systems. So I'm not hugely bearish. There's lots of things to be positive on with respect to the U.S. economy, but the policy mix is just so reckless in terms of still holding all these treasury securities and mortgage-backed securities, issuing so many treasury bills to finance our debt and deficit, and leaving the incoming Trump economic team, who I think are really good, with a really daunting challenge to deal with all this.
Well, Barry, you say you're not that pessimistic, but you're freaking me out a little bit. So let's end on some optimistic part. Where do you want to be, either to hide or take advantage?
Well, listen, if we do get a rate-driven, say, 10% drop in equities, and we almost had that in things like, the equal-weighted S&P and some of these other sectors. But if the correction were to deepen, I would definitely prefer to be in energy, materials, industrials, tech. I think we're going to have some tough comps. Dan Ives is a friend of mine. I agree with him. We're in a technology investment boom, but those stocks are elevated and pretty expensive. So that's where you could definitely have, a correction broaden out and be more highly correlated and draw even the companies with more favorable prospects into it. So I'd probably look at those, again, energy, materials, industrials, financials for sure. What happened today was a big deal. Although I think if Barr had resigned altogether, I would have been more pleased. I don't know what contributions he's going to make to monetary policy from this point. I'd rather have someone like Kevin Warsh on the board, but to help them unwind their portfolio. But that notwithstanding, financials and the improved regulatory environment, I have a lot of conviction that that's going to help return on equity in small banks and bigger banks get back above 10%, which is a critical level.
All right. Well, the bank stocks as a group having a pretty good day. Barry, we have to leave it there. Barry Knapp, Director of Research with Ironsides Macroeconomics, kicking us off to the close here on this Monday afternoon with stocks still in the green, but off the highs of the day. American Airlines, so holding on to its gains. We're going to talk about why three separate analysts are singing the airline's praises.
Plus, just 2 weeks, Donald Trump will be sworn in as the 47th president of the United States. A conversation about some of those big changes that are coming to Washington with Michael Zezas, managing director and head of U.S. public policy research over at Morgan Stanley.
And in just 1 week, we might actually have a dock workers strike on the East Coast of the United States. Talks are set to resume tomorrow to avert that strike. We're going to discuss the potential impacts of the supply chain in this country with the head of one of America's busiest ports. All that and more coming up in a bit, right here on The Close on Bloomberg.
The spot for the Fed's top bank cop officially open. Earlier today, Federal Reserve Vice Chair for Supervision Michael Barr says he will step down by February 28th. The news raises questions about the future of bank capital requirements. Bloomberg News banking regulation reporter Katanga Johnson joins us now. We have Citigroup, 52-week high. We have Morgan Stanley, Capital One, Bank of America, all outperforming on this news. What does this wind up meaning for how banks have to manage their capital?
It had always really been an open question as to how the regulators would ultimately pare back their 19% proposal from last year, 2023 rather. But now that the job for the top bank supervision role at the Fed is open and that role was seen as a key negotiator for the plan, it's yet to be seen not just who will replace Michael Barr, but also how that particular individual will approach renegotiating that top line number for capital requirements.
So is the takeaway that like a Basel III endgame is really an endgame here? Is that a fair assessment at this point?
That's a fair assessment. There have been chatter about whether the plan would altogether be scrapped or whether it would be pared back to being like capital neutral, as some people have described it. It's not yet clear, at least from the government, what the approach would be. But the open question is just in making this the final version of the U.S.'s capital requirements related to Basel, how might both sides agree to what that top line number should.
I was a little curious, Katanga, about Barr stepping aside so early from the end of his term. And I know there is concern that he had about clashing, I guess, with different priorities coming out of the new administration. But this is kind of how it works at the Fed. You have this kind of overlap here. And I thought Basel III had already been watered down enough under his watch that it was already palatable to Wall Street. It seemed palatable to the Fed. So what actually changed over the last few weeks to make him leave as soon as he's saying that he's going to leave?
It's interesting. We did hear in November that Barr would stay in the role into the new administration. We also understand that he knows that if there were a legal challenge to his role, that he feels confident to remain in the role. But the decision seems to have been made around overall whether a bickering, a fighting over whether he should be the right person to continue shepherding the plan in the vice chair role or whether it should be someone else. That bickering is something that would distract from the ongoing negotiations. Yes, there had been some agreement that the plan should be watered back, but some of the other regulators who had to vote on it didn't quite agree on where that number ended in a plan that Barr had previewed. And so there was still more work to be done. To be sure, he will stay on the Fed board, his statement said today, but it's just a matter of not being the key negotiator for this capital plan.
Do we have any sense, Katanga, as who his replacement might be? Is there any names being floated by the Trump administration as to who they would prefer?
It is an open question. We often hear names of people who might potentially want to serve in the role, but there hasn't been any confirmation from the administration as to who they're considering. So that is an open question as we're just learning this news today. Though I imagine conversations around people who'd like to be considered might be beginning to float in the next several days or weeks.
All right, Katanga, got to leave it there. Katanga Johnson, our banking regulation reporter here at Bloomberg, with the big headline of the day, the Fed's vice chair for supervision. Basically, the person who polices Wall Street. He's going to step aside about a year and a half early. Michael Barr set to leave by the end of February, maybe even earlier. All right, when we come back, we're going to focus in on some of the high flyers of the day, and that includes American Airlines. 3 analysts upgrading the stock today. We're going to talk to one of those analysts a little bit later. That's coming up next on The Close. This is Bloomberg. Let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we're going to start off today with Palantir. Morgan Stanley resuming research coverage of the software company with an underweight rating. This after suspending its sell equivalent rating back in November amid a change in analysts and a quadrupling in the stock price. The new analyst, though, says that despite the company's early AI strides, the risk-reward ratio leans toward the downside. The shares lower by 5% here on the day. Next up, let's take a look at Goldman Sachs. UBS cutting its recommendation to neutral. The analyst saying the company's asset and wealth management businesses are unlikely to grow fast enough to become a major driver of overall earnings, leaving the company heavily reliant on its investment banking and trading businesses to carry the load. UBS saying the current valuation reflects limited upside. Investors shrugging it off, bidding the shares up by about 0.9%. And finally, Salesforce. Guggenheim downgrading the software company to sell, saying that while the firm is considered a leader in AI given its Agentforce product, the analyst questioning whether this turns to material revenue ever. Shares lower by 1.5%, and those are some of our top calls. We do have one more for you, and it is a special one. American Airlines, that stock flying high after analysts over at Milian, Jefferies, and TD Cowen each raising their recommendation on the stock to a buy equivalent rating. TD Cowen also setting a new price target of $25, up from $17. The analysts saying tailwinds for American include better domestic pricing, regaining business traffic, and improved credit card economics. You see the shares moving higher by 4%. The analyst behind that call, Tom Fitzgerald, he joins us right now, airlines analyst at TD Cowen. And let's start here basically with the basic supply-demand dynamics here and how it benefits American Airlines. What's the story there?
Yeah, it's pretty simple. Airlines, all the airlines who've had profitability challenges, Southwest, JetBlue, Spirit Airlines, Frontier, they've all either been cutting or ratcheting back their growth. So that's brought supply and demand in the domestic market back into equilibrium and buoyed pricing since about probably like mid-August, early September. And American, by virtue of being the largest carrier in the domestic market, will see an outsized gain from that dynamic. And that's a dynamic we see lasting through 25 and 2026.
The airlines performed pretty well last year, but there were some warnings coming out of the executives at those airlines that while leisure travel was doing well, they had not necessarily seen that rebound in corporate travel, at least not to pre-pandemic levels. What's the outlook for the business travel side of the equation this year, Tom?
We think it continues to get better. We're not expecting a big step change this year, but we think the gradual recovery we've seen keeps going on. We think managed corporate traffic should do a lot better this year, especially if there's a pickup in deal activity or IPO activity. You know, you're going to see a lot of bankers, consultants, lawyers, private equity folks, auditors all out hitting the road. So that's all really positive for managed corporate traffic. Return to office keeps ticking higher. That's really good. If you're a business development person, your clients being back into the office, that makes it more worthwhile for you to hit the road. We got conferences too, CES this week. That's a huge corporate travel event. I'm picking up a flight to Vegas tonight actually to attend that event. So we think we're not a major massive step change, but it should keep getting better. Small and medium corporate traffic, that's been above pre-COVID levels for a while now. It's just been those larger managed, the Deloittes of the world, the road warriors that have been slower to come back.
Hey, Tom, the stock is still up like 90% just since August. So why now? Why not upgrade like 6 months ago?
Yeah, we had unfortunately we had downgraded it at the beginning of the year. We got the timing wrong. We upgraded a year ago and then downgraded it. We were waiting to see if the problems were transitory and if it was mainly the corporate travel issue or see how the domestic market shook out. But we don't think we think there's a lot of upside left. We think there's going to be probably close to 200 basis points of operating margin expansion in 2025. 20+% EPS growth continuing into 2026. The new credit card deal they signed has really amazing economics, and that's going to buoy them into the 2030s. So barring a recession, we think the industry leaders in the airline sector have a lot of runway left.
Yeah, so then to that point, Tom, what is industry specific and then what is American specific?
Yeah, I would say the domestic pricing is industry specific, but there's American's idio just from being the largest player in that market. The regaining corporate traffic, that's specific to American. The credit card deal is specific to American. They probably, by virtue of their corporate struggles last year, they have some of the easiest comps that they're going to be lapping this year. So it's a mix of both.
All right. So then when we talk about this idea of how these airlines, I guess, take advantage of this? Because I feel like we go through these cycles, Tom, where they kind of have these up years and then they don't really, do enough to sort of like shore up their balance sheet or make longer term changes that are going to improve the business. And then when demand drops off, they're back in, that old position that they were in. Are they going to avoid that this time, or at least is American going to avoid that this time? Are they doing more to sort of focus on the long-term health of the business?
Yeah, I think the balance sheet is always so crucial in this industry, and that's a lot of long-only investors we talk to about Delta. Delta's long-term target about taking gross leverage down to 1x, that really resonated with long-term focused investors. American, part of the reason that the improved P&L outlook, that's going to just flow through to the balance sheet, and that should drive the portion of the enterprise value that equity owners own much higher from where it is today. And that's just going to be crucial to deploying all their free cash to take leverage down and pay down debt and de-risk the balance sheet. It's going to be critical.
All right, Tom, thanks a lot. Really appreciate it. Tom Fitzgerald, airlines analyst at TD Cowen. And let's not forget, we have a massive storm in the Midwest. Yeah. It is brutal. We'll have to see how those airlines can handle these kind of delays.
Yeah, well, I just flew back from Chicago, and we were delayed for several hours because of the storm there, which now moved east here. So it was great. It was a very turbulent flight, too, which I always love.
Nice. That's nice. But at least you got out.
Jostled around.
There was a time where, if you were going out of Midway, you were toast.
Oh, and we were sitting on, on the tarmac, and then, it's just kind of like they don't tell you anything. And then they start de-icing, and then they're like, well, maybe not. And finally, we took off, in, some of the early morning hours. But I made it here.
Congratulations.
Yeah, thank you. Thank you. I'm a
Key
trooper.
Worker.
Yeah, I did actually nothing other than just sit there and complain, but I'm a trooper. It's kind of interesting, too, because we talk about this idea of the on-time things for the airlines. They actually did perform pretty well. The domestic airlines last year, Delta, I think, was the number one airline, at least in the U.S., in terms of on-time arrivals. And that's been a big thing. I travel a lot. And I have to say, I feel like the experience is better than maybe what it was, even pre-pandemic. It's a little bit smoother. The delays aren't as frequent, and if they are, they're usually things that are truly outside the control of the airline, meaning the weather or something else.
Two thoughts. One, you just totally jinxed it, so thanks for that.
Yeah, sure.
And two, when you fly business, it's also a little easier to manage that kind of stuff.
Yeah, I still am a man of the people, Alex Steele.
He's not. He flies first class. Also, I guess the big question, though, for airlines is what happens with Boeing this year. And I appreciate Boeing's not an airline, but obviously the plane maker and sort of what their safety features are going to wind up being like, and if they're able to get it together, basically.
Yeah, Pete Buttigieg, who is presumably the outgoing transportation secretary, giving an interview saying he's actually seen progress with Boeing.
This is going to take a long time, I think, at the end of the day. All right, well, coming up, we're going to stay in D.C. and talk to Michael Zezas, Managing Director and Head of U.S. Public Policy Research at Morgan Stanley. We're going to talk about how President-elect Donald Trump's proposed tariffs may differ from the policies that are ultimately put in place, and how do you manage that if you're a market participant? This is The Close on Bloomberg.
Just about 3:30 p.m. here in a chilly New York City. This is the countdown to the close. I'm Romaine Bostick.
I'm Alex Steele. Yes, we got a dusting of snow. You gotta love that, though.
Yeah.
Not that bad.
Did you pay your congestion toll when you came into the city this morning?
Probably that $150 on my Uber. Probably. Gotta check it. Probably I did.
There you go. Thanks for keeping the MTA.
You are welcome. MTA is important. All right, let's talk about some of the market action today, because it's not only what we're seeing in the bond market or the equity market, it's also the dollar. If you take a look at the Bloomberg Dollar Index with the JIP on intraday, you can see that volatility that we saw on the different headlines when it comes to President-elect Trump and tariffs.
Well, this was what I was confused about, because there was a Washington Post story overnight about how he's maybe going to scale back some of the more ambitious tariff proposals. And then, of course, Trump comes out on Truth Social and kind of says, that's all a lie and whatever other gobbledygook. So I don't know who to believe here. Like, is he or isn't he?
I mean, it seems like he wants optionality, which seems to make sense. But the prevailing belief seems to be among analysts that potentially he's going to pare back what he said in the beginning. And that's what we heard back in 2017 and 2018, right? Whatever he says, we're going to pare it back. Whether or not that's true, I have no idea.
And the big question is, what's the impact, though, on the markets? Even if it is pared back, we're still talking about an increase and additional tariffs.
And it could still wind up hurting growth, and it could still move the dollar higher potentially. So let's get more into that. Joining us now is Michael Zezas. He joins us from Morgan Stanley. He's Managing Director and Head of U.S. Public Policy Research. Let's just pick up right on that. The volatility in the dollar was super interesting on a headline. We should be used to this kind of stuff by now after we went through the first administration. What was your take?
Yeah, I mean, I think the story this morning and then the rebuttal really clarified nothing. I think the problem is that there are tariff principles that the president-elect has put out there in terms of wanting to make sure that the U.S. and its trade partners are on more equal footing from a tariff perspective. But then there's a question of what could actually be implemented with executive authority versus congressional authority. So even when you see a headline this morning or the news report from the Washington Post this morning about doing universal tariffs on a product by product basis, maybe that's still going to be part of the full package that's been put out there. But to us, the signal there is that implementation of this policy and many other policies that they're talking about are probably going to come a bit slower than one would expect, because in lieu of Congress granting that product by product authority, you have to work through things like Section 232, which have study periods and comment periods. And so I think it's very plausible that a lot of these tariffs are going to go on, including some very aggressive tariffs on China. But the implementation could kind of ramp up over time. And so what that means is that we think a lot of the growth pressures that emanate from these policies probably become more of a 2026 story than a 2025 story, leaving us with a pretty benign backdrop for risk assets, at least to start the year. If we're wrong, of course, and the implementation is faster and more severe, it's a different story, of course.
So what I'm hearing from you, it's like a sequencing, speed, and then implementation, like how those three things interact. So this is our tariffs, a 2026 story. Could this year actually be more bullish? Like, will we have, tax cuts? Will we have deregulation? Does that actually propel the market?
Well, I think that's right. And so to your point, sequencing severity matters a lot. So our central case is that the sequencing here is that the things that can be done through executive authority will be done quickly. That leans more on regulation. It leans more on things like immigration. And it's not that there's not executive authorities that can't be brought to bear to raise tariffs. It's just that the implementation of those takes a bit longer. So the growth challenging stuff it can be created in 2025, but really sort of felt in 2026. So again, that you sort of have this relatively benign macro backdrop going into 2025, where economists already thought we were headed towards a soft landing. Public policy doesn't really interact with that. And then the volatility created by public policy choices becomes something that matters later in the year or into 2026.
I am curious if there's any sense here, Michael, that based on the potential nominees and some of the other folks that we think are going to be in his either in his cabinet or in his advisory orbit, are any of those voices potentially going to, be that calming influence? Are they going to smooth out maybe some of that volatility by being, a little bit more of a voice of reason?
Yeah, I don't know if I'd describe it as like a calming influence or a voice of reason, but I think these are what these appointees are saying about how things would be implemented. I think give you some signal about the difference between, for example, if there was going to be blanket tariffs on all imports on day one, as well as taking China import tariffs up to 60%. That's a scenario our economists have assessed and say that would add like 1% to CPI almost immediately, and 1.4% downward pressure on growth pretty quickly. But if the implementation is going to be staged over time for both reasons of process, but also some of these appointees saying they want to kind of mitigate the impact to the economy over time and allow it to absorb it, then again, you get pressures that are sort of smaller and more deferred. So when you think about someone like Scott Bessent, for example, he's telling you what he thinks the implementation should be. Is that a calming voice? I'm not really sure that I would describe it that way, but the implementation matters a lot. And these people are signaling that the implementation is going to be more phased in.
Michael, one sort of aspect of this that I don't think we talk enough about is kind of the interplay with the other nations and how those leaders react to any either new tariffs or increase in tariffs. What is going to be that interplay? Do you think that some of these other nations, whether it's Europe, whether it's Canada, Mexico, China, et cetera, do they have the leverage to even push back on some of this stuff?
Well, I think almost certainly they'll push back and they'll raise tariffs in their own ways as a countermeasure and a counterbalance. But, on net, because of how much the U.S. imports, this will be something that in the aggregate, if you were, again, to assume universal tariffs, which we're not assuming, that's something that on net would hurt the U.S., but it would probably hurt the rest of the world a little bit more. So there will be reciprocation because that's standard in any negotiation. But that doesn't mean that the economic impact to the U.S. would be greater than the reciprocating nation. It would, in most situations, it would probably be the inverse.
So if I'm a market participant, Michael, what do I do? Like, what asset do I trade on this? Like, what assets are vulnerable? What assets will do well? How am I supposed to think about it?
Yeah, well, so you talked about foreign exchange at the top of the segment here, and I think that's an interesting place to look. From our FX strategist perspective, there was a lot of dollar strength that was already baked in on the idea of tariff implementation sort of coming quickly and rather severely, because we expect more of this phase. And I think some of the market action you saw this morning with dollar weakening, that's what we expect to be more of the trend in the beginning of the year. If you start to see signals that were wrong and actually, in fact, the implementation is going to be much more severe, then you would expect more dollar strength. So the dollar is one place to look. And then just kind of risk assets in general in the equities markets, right? So more severe implementation immediately is something that would cut against what the view we have right now, which is a rather constructive view on equities within an asset allocation. That overweight, if we were to see signals that the policy path I just described is too benign, then we might reconsider having an overweight to equities and instead lean more on government bonds.
All right, Michael, great stuff here. Mike Zezas, Managing Director and Head of U.S. Public Policy Research at Morgan Stanley. Alex, of course, as we await here the inauguration of President Donald Trump on January 20th, when presumably some of these policy proposals will start to take effect. We continue to count you down to the closing bells here in New York just about 20 minutes ago. And one of the big movers on the day is Fubo, a big way. The company making a media alliance with the Mouse House, Disney. We're going to talk about how the latest streaming deal is sending shockwaves through the sector. It's our stock of the hour. It's up next, coming up on the close on Bloomberg. All right, let's get right to our stock of the hour. Fubo TV, more than doubling, almost tripling in price today after Disney announced it's going to fold its Hulu and live TV business into the streamer, creating the second biggest digital pay TV provider in the sector. In conjunction with the deal, Fubo has settled all litigation with Disney and ESPN related to that sports venture that they had announced last year. Joining us for more is Bloomberg's Lucas Shaw, and let's talk about that lawsuit. It immediately drew a lot of condemnation from Fubo and others that it was, I guess, monopolistic in a way, at least their words here. So this puts all that to rest, I assume?
Yeah, the big takeaway, I think, is probably the settlement of the suit blocking Venue, right? Venue is this joint venture that Disney and Warner Brothers Discovery and Fox had created to give live sports channels to sports fans outside of that core cable bundle. Fubo objected to it because they wanted to create similar packaging for their customers and said these companies wouldn't let them do it. As a result of this deal, that lawsuit goes away. Venue more than likely is able to launch later this year unless someone else steps in to try to block it. And then you have now Disney being the majority shareholder of Fubo.
Now the majority shareholder, and I assume that even with Venue launching, the idea is that Fubo TV, independently on its own, will be able to have its own content coming from those networks that are part of the Venue deal.
Yeah, absolutely. I mean, look, Disney is part of Venue, and yet Disney is also launching a standalone ESPN streaming service later this year. You know, all these media companies are trying to find so many different ways to plug the holes that have been created by the fall of the cable bundle. And so you'll have Fubo, you'll have Venue, you'll have what they're calling ESPN flagship. There will be no shortage of ways for sports fans to watch live sports. Whether any of these packages are their favorite or preferred or really stop the bleeding for companies like Disney, we don't know.
Hey, Lucas, are the regulators going to have any issues with this?
You know, I don't know, but I don't see why they would. I mean, it's a little bit strange, I guess, for Disney to own or kind of add to its pay TV business. But look, Comcast is one of the biggest pay TV operators in this country and also owns NBC Universal. Disney already owned Hulu, so this is sort of Hulu in some ways uniting with a smaller competitor. Even combined, it's the fourth biggest player. Comcast is bigger, Charter is bigger, YouTube TV is bigger. Fifth biggest player. And I believe one of the satellite companies is bigger. So I don't see a reason for there to be regulatory issues, but I would never rule it out.
No, fair enough. Interestingly enough, I have to wonder, too, is this just the next step into sort of the cable bundling, but on streaming, and kind of like what the next iteration is of this?
I mean, look, I'm curious. There are a lot of people who thought Disney wanted to get out of the Hulu live TV business because these live TV services, the newer ones that came about, most of them don't make money, right? Fubo reports numbers. It's unprofitable. Hulu live TV, they don't report it out. I'd be shocked if it made money. YouTube TV, you can see they continue to raise prices because it has been unprofitable. So I guess I'm most surprised that Disney is sticking in it, but it clearly wants to make Venue happen, and this is one way to ensure that it does. And it also puts one of its antagonists to the side.
All right. Hey, Lucas, super appreciate it. Thanks so much. Lucas Shaw of Bloomberg joining us there. Would also say in the entertainment world for a second, the Golden Globes was yesterday. Romaine was in an airport, so maybe you didn't see them. But I have to tell you, I remember the days where I would make money off of Golden Globes and Oscar races. I would take it really seriously. There'd be pool and money and the whole thing. I knew none of the movies, none whatsoever.
Yeah, I was just in preparation for this conversation, Alex. I was going through them all. I don't think I've seen anything on this list, but there are a few that I'm interested in. I want to see The Substance, which is what Demi Moore won for. And was it I'm Still Here? That sounds like a good movie.
I don't know.
Oh, okay.
That's the point. I didn't know any of them. How do you get excited about an award show when not everyone's seen all the movies?
Now you can go see them. And this is the run-up to the Oscar.
It's streaming. It's on, and then you have to pick it.
Oh, I don't have to go outside?
Totally wrong. It's weird and wrong. All right, Ed Clissold will be joining us right next.
We wind up the year unchanged, but that's highly, meaning around 4.5% on 10s, but that's highly contingent on making progress towards incoming Treasury Secretary Bessent's first era, which is a 3% budget deficit.
Barry Knapp over at Ironsides Macroeconomics kicking us off to the close just about 50 minutes ago. And when we kicked you off to the close, the S&P 500 was hovering about a 1% gain on the day, though it's given back a good chunk of those gains as we get closer to the bells.
Yeah, the Dow flipping now into negative territory. Just check that out. Also, the Russell, same deal. Meanwhile, you have the chip stocks, though. They're still outperforming, up by almost 3%. But again, we were even higher earlier. So it seems like tech and chips, like Nvidia, still leading the way, but we are giving up some gains. That can't bode well technically when you have a rollover like that in the middle of the trading session. Yeah, well, if you're looking for a bright spot, crypto is at the highs of the day. Bitcoin back around that $102,000 mark, and yields right now across the board pretty much where they've been for the last few hours, relatively up by about 2 basis points from the 5 to the 30-year basis. 2-year yields down slightly on the day. Ed Clissold joining us right now, Chief U.S. Strategist over at Ned Davis Research, to help us count you down to those closing bells. And Ed, we kicked off the show with the conversation about some of the correlations, the negative correlations between what's going on in the Treasury market and what's going on in the stock market. And the idea here that poses a certain degree of risk for stock investors that maybe, I guess, are just riding this wave a little bit too long. Do you worry at all about the direction of yields and the impact that could have on stock valuations?
For a couple of reasons. One is it does provide implications for what the Fed may be doing, what the market thinks the Fed will be doing, and that's a big risk for the year, whether or not the Fed is going to be able to follow through, even on what they were implying for just a couple of cuts. And then secondly, if interest rates get too high, that big decision, the main allocation decision that investors make between stocks and bonds will really get in favor of stocks. Last decade, there wasn't a decision. Rates were so low, it didn't matter if rates went up a little bit. Stocks were still the best game in town. That's no longer the case. And then the final point on that is speed matters. If rates go up slowly, investors can digest it, companies can adjust. But if it happens very quickly, which we've seen, a nice jump over the past several weeks in bond yields, that's a shock to the system, and the reallocation happens quicker. And then that turns the whole momentum of the market upside down. So we got to watch all that.
Obviously, a big driver of the market gains last year was, of course, the Fed's fight against inflation, which, largely successful, not over, but certainly largely successful. And of course, the earnings expansion that we saw, at least for a certain cohort of the large cap names in the S&P 500. Does that continue this year, Ed?
The way we look at it at NDR is that it's still going on until it's not. So we're still overweight stocks versus bonds and cash. We're still bullish on an absolute basis. But those are our two biggest concerns for the year, that inflation maybe drifts higher back towards 3%, driven by sticky housing inflation, sticky super core, and then the risk of higher goods inflation from tariffs and deportations. And then on the earnings front, it's been so driven by the Mag 7. Look, these companies have been fantastic. They produce great amount of earnings growth, cash flow, to the point they can reinvest in AI or returning billions of capital to shareholders through buybacks. I mean, it's just a great group of businesses. But trees don't grow to the sky. They're not going to be able to produce these huge year-over-year earnings growth stories over and over and over again. So it's going to be incumbent upon the other 493 stocks to pick up the slack. And that's going to be a challenge. So if we go through a period...
But if we flip it, one might say, sure, but it's not like we're going to see negative earnings from the Mag 7, right? It's just growth will go from, like, say, 20% to 10%. Like, that's not terrible. Does that really change the valuation structure that much?
Well, what it does do is it changes how investors think about it. So where we study this, what we realize is that it's not just are earnings growing, are they accelerating or decelerating? If you want to think about it mathematically, that's your second derivative. You want to go back to your calculus days in high school. And so as you go from 20 to 10, that means your second derivative is negative. You have earnings deceleration. And in that environment, stock gains are quite a bit less. And so it does matter. Now, does it mean you have to have a nasty bear market or recession? No, that's when earnings growth actually turns deeply negative, like minus 20% or worse. That's not what we're looking at. But it's just a more difficult year when earnings are slowing versus when they're picking up.
Gotcha. It was really interesting. Scott Rebner over at Goldman Sachs, he studies a lot of the flows in the market. And he said right now what he's seeing is FOMO, so fear of materially underperforming your benchmarks. And that's where you're going to have any kind of catch-up kind of potential. Do you also see that right now in the market?
Well, first of all, that's kudos. That's a
right.
A great
it's pretty
phrase.
good, isn't it?
But, yeah. Sell-side strategists love to come up with those things, so that's a good one. But no, there certainly is that fear of, like, last year was so difficult. 29% of stocks in the S&P 500 outperformed. That's the second lowest percentage ever. And so it's really difficult to outperform unless you're in those few names that are doing super well. And so that's going to lead to piling in. I think you're seeing that today of investors putting money into the winners of last year because they think they're going to continue to do so. So that's that's something that can continue until the music stops. And then you look at it and you say, wow, how overexposed are we? The top 10 stocks in the S&P 500 are 39% of the index. That's a record high, even more than the dot-com bubble, even more than the Nifty 50 in the early 70s. So when this music stops, it means that there's going to be a pretty quick move to the exits.
I am curious, though, what makes the music stop, Ed? I mean, there's always got to be a catalyst, and I know technically you can't really answer that because who knows, but I'm sure you have to have some sort of sense of what you're keeping an eye on that could be sort of that final sort of, that final sort of marker for this rally.
I think the answer lies in the bond market. If we see the 10-year yield blow past 480 towards 5% in short order, that's going to cause investors to really think of things in a different way. And then we'll have to see what this earnings season looks like. If we get all systems clear from the Mag 7 and a little bit better earnings growth from the rest of the market, I think it's a coast is clear. If we start seeing some warnings from companies that 2025 is going to be a more difficult year, that could be a trigger as well.
Ed, always a great conversation. Ed Clissold, Chief U.S. Strategist over at Ned Davis Research, counting us down to those closing bells here on this Monday afternoon. Just about less than 3 minutes to go here. The S&P now sitting on a gain of about a half a percentage point. It was sitting on a gain just a couple hours ago of about 1.3%. That's
kind of an ugly rollover there. We also get a lot of supply in the bond market, which you have to wonder, too, if that's going to wind up moving. We saw the 3-year wasn't that great of a takedown today. Yeah. So when we get 10-year and 30-year, it's pretty heavy, and I wonder how that's going to play into the equity market as well.
The VIX slightly elevated on the day, back around 16. Bitcoin getting a nice bid, and the dollar strength, not much strength at all, down 0.6% on the Bloomberg Dollar Spot Index. Volatile, and I think it could be more volatile, particularly given what we saw this morning on those reports about Trump's tariffs. A full breakdown of all your market coverage starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick, I think I'm still here with Alex Steele. She might have left. But we are going to take you through the closing bells with our global simulcast. It starts right now. Scarlett Fu in the TV studio, Carol Massar and Tim Stenovic in the radio booth as we welcome our audiences across all of our Bloomberg platforms to parse the most crucial moments of the day. We were sitting on a pretty massive two-day rally, Carol Massar, but the second day of that rally fading just a little bit as we get closer to the close.
Yeah, I thought it was going to be a two-day bounce back, right, following off of Friday's rally, but not to be. And maybe some confusion over what we're going to get in terms of Trump tariffs. Maybe people are just waiting. We have a lot of jobs data, economic data, Fed minutes coming our way, so maybe people are just waiting.
How have you guys not talked about Bitcoin?
We did. Romaine did.
Okay,
we did. Do you
he
not watch our
delivered.
show?
He does not watch.
What have you been
rude.
doing for the past hour?
For the past
3-hour show.
For the past 2 hours.
Oh, okay.
Bitcoin back above $100,000. 102,000 right now, up another 3.7% today. See if we see some new highs. Maybe ahead of Bloomberg Crypto tomorrow.
Oh,
noon.
look, shameless
Look
tease.
at that. Shameless plug there.
You got it.
Let's not forget also Nvidia was a big gainer in earlier trading and gaining as much as 5.3%. It's paired its advances as well. Jensen Huang going to be speaking at CES in Las Vegas. What is he going to say about Blackwell, the next gen AI chip that everyone has put so much of their hopes on AI on?
And also, you already saw Nvidia kind of rally today. You had the chips index doing pretty well, SOX index doing well. Nvidia, the outperformer there. Is that already baked in at this point? And is it going to be a show me story today at CES?
Yeah, absolutely. Though there's some folks, some analysts on the street, of course, a little concerned here about when we see the payoff in AI, that downgrade earlier today for some of the software companies like Salesforce and Palo Alto over at Guggenheim because of concern that the payoff for AI might not actually materialize for some of those companies on a revenue and profit basis. We get the closing bells in New York. A little bit of reason to cheer. The S&P off the highs of the day. It's going to close back below 6,000, but it's still higher on the day by about 30 points or 0.6%. The Nasdaq Composite higher by about 1.2% on the day, or about 240 points. The Dow Jones Industrial Average and the Russell 2000, those are your outliers, each lower on the day by only by a fraction of a percent, each down about 0.1% on the day.
All right, back to the big caps, the S&P 500, guys. Not quite an even split, but pretty close to it. Scarlett, you've got 232 names to the upside, 268 to the downside.
All right, let's take a look at the IMAP, which shows the breakdown by economic sectors. And you have 4 sectors in the green: communication services, infotech, and materials leading the way. Infotech up 1.4%, communication services gaining more than 2%. On the flip side, your laggards include real estate investment trusts and utilities, each losing about 1%. Consumer staples also down by almost 1%.
All right, a fair amount of green there. And Scarlett, you really kind of teed up my gainers today because you have the Philadelphia Semiconductor Index, folks, well off its highs, at its highs up about 4.2% in the Monday trade, but finishing the day just up about 2.8%. You had Nvidia server assembly partner Foxconn coming out, and they reported faster than expected revenue growth on continuing demand for AI infrastructure. So that really kind of helped give some enthusiasm and juice the overall sector. So on that, kind of staying with that trend, Nvidia, as we talked about earlier, at its highs, up more than 5% in today's session. And we do see a new record when it comes to Nvidia, so topping that peak that we saw back in November, finishing the day, though, with a gain of about 3.4%. Jensen Huang is expected to give his speech from CES in Vegas. That's 9:30 p.m. Wall Street time, so 6:30 p.m. local. So we'll be looking for anything he has to say about new products. So that will certainly be something to keep an eye on. And Supermicro Computer, number 2 gainer in the S&P 500, guys, up more than 9% in today's session. Lynx Equity Strategies writes that address from Jensen Huang at CES could be a positive catalyst for the stock. So something to keep an eye on. Certainly Nvidia, but really that overall space. And I should point out, Stryker nearing a deal to buy Inari Medical. This is something that happened late days. Reuters reporting this, and Inari Medical was up about 30% at its high, so kicking up higher on that news.
All right, Carol with the gainers. I got the decliners. I do want to start with ADRs of Tencent Holdings Limited, falling today by more than 7.8%. This after the Defense Department said the tech firm was a Chinese military business operating in the U.S. Tencent, among several companies that were labeled as Chinese military entities in a Federal Register filing. Now, this blacklist from the Pentagon doesn't in and of itself carry specific sanctions, but what it does is it tends to discourage U.S. firms from trading with entities on that list. In a statement, Tencent said its presence on the list was clearly a mistake. We are, quote, not a military company or supplier, a company spokesperson said. And paychecks down today by 2.6%. They fell after the company reported that the payroll processing company is in advanced talks to acquire Paycor HCM. A deal could be announced as soon as this week, according to people with knowledge of the matter. Paycor shares, by the way, jumping more than 20% in today's session. And finally, rounding it out with Palo Alto Networks. Shares fell today by about 2%. This after Guggenheim Securities cut the recommendation to sell from neutral. Price target set to $130, a 29% decrease from closing yesterday.
I gotta say, guys, some of the action was most definitely within the bond market. So I'm taking a look at where we ended. You're looking at the long end up by about 2-3 basis points. The front end saw a little bit of buying, but we had a 3-year auction and it really wasn't that awesome at the end of the day. You had indirect bidders were not great. The lowest in about 3 months. Yes, the bid to cover was strong, highest in September, but it was the dealers and direct bidders that had to pick up all that slack. We don't love that. And that's headed into the 10-year auction tomorrow. 30-year on Wednesday. We get $39 billion tomorrow. That's, I think, going to be really interesting, particularly if we're talking about 5% yields in the 30-year, 4.5% on the 10-year, or past that. But that's going to be interesting.
Yeah, Michael McKenzie was on earlier talking about some of the auctions this week and saying, especially when you're looking at longer term, investors want to be paid to make those bets longer term. All right. To some of the stories that are on our radar. And I know everybody's been talking about the congestion pricing that kicked off in New York City. It makes us think a lot about mass transportation. For any of us who take it, we all do, I think it's safe to say. New York City subway, not a great year. Violence. It's one of the most dangerous years on records, 2024. And so we're just seeing violent incidents. I mean, just look at the headlines. I feel like over the last couple of weeks, it's been pretty rough for anybody who's riding the New York subways.
Yeah, Catherine Wild, who runs the Partnership for New York City, it's a business group made up of the city's largest companies, JP Morgan Chase, Goldman Sachs, and more, says that the MTA is going to have to spend more to improve safety on trains. I wonder if that will happen as a result of congestion pricing, which kicked off yesterday. But it sort of remains to be seen. There's this tension with getting people back to work, filling up offices, and making sure that people feel safe on their commute.
Well, that's what I'm curious about. I mean, half the point of the congestion pricing was to funnel that money to make improvements to the MTA, both in terms of security and other things as well. And I know they've tried to make some improvements since the pandemic, and I've noticed a few, but, it's a pretty sprawling network. I mean, I don't know. I mean, how much can you do beyond what's already been done?
Well, also, isn't it all relative? Like, if you grew up in New York in the 70s, this is so much better. But, it's still violent. So it's like, isn't it relative basis?
What's troubling for a lot of people is just how random it is. In a lot of cities around the world where they're really not great neighborhoods, you know what to avoid, you know how to stay safe. But if you're taking the subway and it could happen in any subway station, then it just feels like you have no control over the situation at all.
All right. There's actually some breaking news right now on Ulta Beauty. The CEO set to retire. The company out with a statement announcing the CEO transition, saying that Dave Kimball will retire as chief executive officer after 11 years with the company. Right now, Keisha Steelman, who's the president and chief operating officer, will succeed Dave Kimball as president and chief executive officer. That is in effect today, January 6, 2025. There you have it. Ulta CEO retiring after 11 years. The COO now is going to be the CEO starting today.
Another story that we're paying a lot of attention to, of course, is the idea that talent is hard to get. And when you do have it, you want to hold on to it for as long as possible. Citadel, the hedge fund run by Ken Griffin, has extended its non-compete agreements for some of its portfolio managers to 21 months, which is way longer than a lot of its
rivals. Can I ask a question? Is this just garden leave?
No.
So this is different than garden leave. So you don't get paid for these 21 months while you're just waiting around to switch jobs? We don't know.
Well, I bet the company that's hiring you would have to account for you not getting paid during that time, right?
That's a good point.
So then the new
there's got
firm
to be
There's got to be something. I mean, because if you're losing pay for 21 months, there's going to be some kind of backlash on that.
You're out of the game. You're not keeping up to date with stuff.
Yeah.
I guess.
Hey, can I pivot to other breaking news?
Yes, please.
Meta. You remember Dana White?
Yeah.
He's now going to be on the Meta Platforms board.
That's interesting.
Wow.
So UFC CEO Dana White being added to the board over at Meta Platform. In fact, 3 new directors being added to the board, including Charlie Songhurst and John Elkin. But probably the name that's going to get the most attention is Dana White, who, of course, runs the Mixed Martial Arts League, UFC.
And didn't they just change their head of policy as well, right? From Nick Clegg to Joel Klein, who's the Republican.
Yeah, you see what's going on.
The resident Republican in the company.
And Dana White, of course, kind of the resident Trump friend, buddy, if you will. He has a long-standing relationship with the president-elect. So,
Mark Zuckerberg's made a couple of trips over to Mar-a-Lago as well.
I've heard, yeah. Is that going to pull you back onto Instagram, the metaverse, whatever he's got going these days?
The metaverse?
Who
talks about the metaverse these days?
Mark Zuckerberg, I don't know.
But he probably hopes to avoid all the ire from Mar-a-Lago, though, that's for sure.
Yep.
It's going to be interesting, guys. It's going to be interesting. All right, that's a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. We call it Closing Bell. We'll see you again, same time, same place tomorrow.
All right, we continue our coverage right here on Bloomberg Television. Stick with us. We're going to talk about what a strong consumer at the end of 2024 means for the U.S. economy in 2025. It's not quite what you think. Michelle Meyer, chief economist over at the Mastercard Economics Institute, joins us after the break. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic here on the first trading day of the new week. And well, you had gains, not necessarily across the board, but some people will take it. Another day of gains for the S&P 500, but it was actually up as much as 1.3% on the day. It paired some of those gains as you got closer to the bell, closing out the day up about 0.6%. Of course, leading the charge today was big tech. You saw that reflected in the Philadelphia Semiconductor Index, really getting its mojo back today in a big way, up about 3%. Utilities not holding up. And there was an interesting story in the hydrogen space, believe it or not. Plug Power, that was one of the biggest gainers on the day on a percent basis, up about 20%, largely on the back of some new rules coming out of Washington that should favor some of the hydrogen companies. An index tracking those stocks up about 2.3% on the day, Scarlett.
All right, let's stay with the theme of gainers and take a look at Nvidia, the biggest advancer among the Mag 7 names, gaining 3.4% to a fresh record high. The CEO, Jensen Huang, will be speaking at 9:30 p.m. Eastern Time, 6:30 p.m. Pacific Time at the Consumer Electronics Show in Las Vegas, and presumably he'll talk about Nvidia and their next-gen AI chip Blackwell. And any commentary on that perhaps could be a catalyst for the next leg up in the stock. Fubo, biggest gainer in the Russell 2000, more than tripling in value. It was at $1.44 on Friday. You can see it closed above $5 today. Disney will merge its Hulu Plus live TV streaming service with Fubo to create a new digital pay TV provider that will be the second biggest after YouTube, so separate from cable television, right? Disney will become the majority owner of this new company, and Fubo will actually also settle all its litigation tied to Venue, which is the new sports streaming service that Disney had planned to launch with Fox and Warner Brothers Discovery. You can see Disney closing down just marginally about 0.1%. Our top story this hour is on how North America is at the dawn of a new political era. In Washington, Congress formally certified Donald Trump's presidential election victory in a ceremonial sign of the peaceful transfer of power, a stark contrast to just 4 years ago. While in Ottawa, Justin Trudeau yielded to pressure and resigned as prime minister, kicking off a leadership contest in his own party. For the U.S., the next step will be to set policy. Trump is intent on applying tariffs to foreign goods, but so far keeping mum on how broad or narrow they may be. This uncertainty over trade is creating an overhang on the global economy, right as U.S. dock workers and port operators resume talks tomorrow to avoid a damaging strike.
Yeah, we're going to spend some time talking about that over the next hour. But first, some breaking news involving medical device maker Stryker. There were rumors that it was planning to buy a smaller rival, Inari Medical. They've now confirmed that Stryker has reached a deal to buy Inari Medical for $80 a share in cash. Inari, which rallied more than 30% in the cash session, now higher by 20% here in the after-hours trade. But we do want to turn our attention back to the U.S. economy and back to the consumer, a consumer showing signs of strength. At least that's according to Mastercard's latest report. Retail sales up 3.8% year over year during the holiday season. They're highlighting, quote, consumers' ability and willingness to spend. Michelle Meyer is chief economist over at the Mastercard Economics Institute, and she joins us now to talk a little bit more about these trends. Michelle, it was a good holiday season, no matter how much you cut it here. And there's a lot of questions about just how much is left in the tank for the consumer. It just seems like no matter what challenges, no matter how much credit card debt, we're continuing to spend. That continues?
Well, I think you definitely don't want to, underestimate the resolve of the U.S. consumer to spend. But I also think if you look at the fundamentals, it's supportive, whether you're looking at the labor market where wage growth is currently outpacing underlying consumer inflation for goods and services, or if you look at the household balance sheet in terms of the wealth gains throughout last year, they were impressive. So for those that were fortunate enough to be able to access those, either in the financial market or in the housing market, it's been a pretty positive wealth effect that I do think played a role as we look at the end of last year in the holiday shopping season.
When you look at some of those numbers coming out of the holiday shopping season, how much of that growth that we saw, how much of that sort of strength was also a factor of the retailers providing better discounts, at least better than maybe what we saw in the previous holiday season?
Yeah, so that's an important point, Romaine. When you think about the spending numbers, 3.8%, that's nominal spending. And when you dig into those numbers, actually, there's been a lot of disinflation, or even for some categories, outright price declines or deflation. So when you back out and look at a real measure of holiday spending, it was strong this year. It was stronger than the last 2 years in terms of real spending because retailers came in with a good amount of promotions and incentives to encourage consumers to spend. So that it is a factor, and it'll be interesting to see how that plays out as we look into 2025 in terms of when and why consumers are spending.
At the end of last year, we did hear about how brands, merchants, stores were perhaps increasing their orders on concern that there would be a strike by dock workers at U.S. ports, and also on anticipation that there would be tariffs as well at some point in 2025. We know that there's a buildup of inventory. Do we know whether consumers actually purchase more as well?
Well, I mean, I think as you mentioned, the census data certainly shows that exports have been rising for some time, which probably has a lot to do with the anticipation of tariffs and trade tensions. And that is resulting in some increase in inventory to sales ratios, probably intentionally, again, as you mentioned, Scarlett. But I think for the average consumer, they're not necessarily thinking about all of these potential policy changes because there's so much uncertainty. It's so unclear right now in terms of what the policies will be in terms of tariffs across different products and how that will impact each individual. So I think for the majority of consumers, and certainly what we saw during the holiday season, they were incentivized by the ease of spending, with e-commerce doing very well, 6.7% increase in holiday spending online. So e-commerce certainly benefiting. And the availability of products, just the increase of choice for consumers, I think makes a big difference as well as they continue to look for that value out there.
Absolutely. I'm curious as to what the numbers look like when you break it down by region, by geography, because we know that consumer confidence is the underlying driver for how much they'll spend. And confidence differs whether you live in a blue state or in a red state on the coast, or in a state or in a region that has seen incredible job growth.
Absolutely. There's definitely not a uniform story, whether you're looking at it across the regions or you're looking at it by different income levels. So the aggregate numbers really mask what's happening in terms of the details. And on a regional basis, we saw quite a lot of strength in the Southeast. That's been a part of the country where job growth has been very strong. The economy has done quite well, and you're seeing strong income growth and therefore consumer spending. So places in Florida, in the Carolinas, are showing some outperformance. If you look back the last few years, we've seen a good amount of outperformance as well in the mountain states. That's been another part of the country where there's been pretty solid economic performance.
What's going to be the balance this year, Michelle, in terms of spending between goods versus services? It seemed like services kind of dominated a good chunk of last year, maybe before we got to the holiday season. Do we go back to that? People buying experiences instead of actual physical material items?
Well, I think all else equal, we're probably going to see more of a balanced basket in 2025, which we started to get a hint of in the holiday season with things like jewelry and electronics showing some real meaningful improvement in terms of spending numbers in 2024 relative to 2023. So I do think it should be a bit more balanced, especially, again, because of promotions and discounting that will help incentivize people to go back and return to certain goods spending. That said, a lot of it does depend also on not only relative prices, but policy changes. When you think about tariffs, which categories are going to be hit the most? Is there certain goods categories or experience categories? And how do consumers react to that when you think about the relative pricing?
All right, Michelle Meyer, always a pleasure to speak with you. Michelle Meyer is chief economist over at Mastercard Economics Institute. And to your point, Romaine, about whether people are buying goods or services, you think about the President's Day sales that they usually launch and people buying appliances or encouraging you to buy appliances.
Yeah.
If they're going to impose tariffs, how is that going to play out? Right?
I don't know. They better buy them quickly. I don't know. But it gets to this idea, though, too, is like, what more do we need? Wasn't that kind of part of the narrative of why we sort of shifted more to services? It was like we bought everything we could possibly have needed during the first couple of years of the pandemic. Then
But it's now been a couple of years since the pandemic, so you got to refresh.
Okay, so you're in the market for a new washing machine?
Sure,
Is that what
why
you're
not?
telling me?
Yeah, washing machine, dishwasher, all of that. Coming up, we've got the top three where we focus in on the top three movers and shakers at the center of the day's big stories. This is The Close on Bloomberg.
Wednesday, SEC Chair Gary Gensler sits down for an exclusive interview with Bloomberg's David Gura as he prepares to leave office. Tune in Wednesday at noon Eastern, only on Bloomberg.
Time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Jensen Huang, the co-founder and CEO of Nvidia, will be taking the stage at the CES trade show in Las Vegas tonight. 9:30 p.m. is when he begins speaking. That's about 6:30 p.m. Pacific time. Investors clearly hoping, Romaine, that he'll say something that'll juice up Nvidia shares, which did close at a record high today.
Yeah, I'm not sure exactly what he can say that he didn't already sort of lay out in the last conference call, unless he's got obviously some sort of top secret, update on the Blackwell chip up his sleeve. But of course, when he talks, people will listen. Are there watch parties for this, like the way there was?
There probably is, yeah. My guess is
Joe Weisenthal.
I mean, it's at the right time, 9:30 p.m. Eastern time.
Yeah,
Maybe he'll say something like insane again, and that'll get everyone going.
Possibly. All right, I'm keeping an eye on Demi Moore. You remember her?
I do.
I love her.
G.I. Jane?
I just learned that she had never won a Golden Globe. She actually won last night for her role in the show The Substance. It was her first ever acting award, which I was kind of surprised by because I was going through her filmography, a few.
You went to IMDb, yeah?
Indecent Proposal, all these
Ghost.
other movies. No, she didn't. No, she was awful in Ghost. But then there were a couple others, and you're just thinking like, wow, she never got number one for this. So good for her, given she's 60-something years old.
She's 62.
And she looks great.
Yeah, she was nominated twice in the 90s for Ghost in 1991 and If These Walls Could Talk, also as a producer. But everyone really liked her speech because she was talking about how she'd been doing this for 45 years. And, finally it happened. All right, third on the docket is Sam Altman. In an exclusive interview with Bloomberg Business Week, the OpenAI CEO discusses his infamous 4-day firing, how he runs OpenAI, and his plans for the upcoming Trump-Musk presidency. That was a Freudian slip. And his relentless pursuit of AI.
Yeah, from your lips to God's ears. And of course, this is all anybody is talking about. It is the cover story in the latest issue of Bloomberg Business Week. Mark Milian joining us right now, who helps cover all things tech for us down there. And fascinating interview from a guy that I think we're all going to be fascinated by in some way or another this year, no matter what he does or doesn't do.
Yeah, I mean, this is a person with a great deal of power, and it was a nice opportunity for our writer who got to spend 2 consecutive days with him in San Francisco.
What was the main thing we learned though from him?
I mean, it was a very wide-ranging interview, and it's a long one, so it's a time investment.
Yeah.
But he went from sort of his outlook on, as Scarlett said, the Trump-Musk presidency. Mm-hmm. He's got a very strained relationship with Elon Musk. So we talked a little bit about his sort of optimistic take on how he can repair that relationship.
He wants to repair the relationship with Elon Musk?
I think he wants a working relationship because he understands that Musk is going to have a great deal of power.
Well, based on Musk's most recent X posts, I don't think he's actually wants a more
Maybe he can be won over, just a little flattery.
Yeah.
I mean, the thing that I'm fascinated most by is this idea of looking back at whether this for-profit company, OpenAI, had an issue with reporting up to a non-profit board, which was always kind of this source of tension in the company.
Yeah, so it's been about a year since OpenAI fired him, and he came back after about 4 days. But this was really like the most in-depth he's talked about that experience in any interviews over that time. It seemed like with some time to reflect, he came back, and he's still very mad about that experience. And so the responses were pretty visceral, but he gave his point of view about where things went. He sort of talked about how the board felt like they had a moral obligation to get rid of him, but he says, obviously they're misguided.
But this is for the most part now being run as a for-profit enterprise. There's been a ton of investors in this and that are going to want to see a return. When do we see that return? Did he talk about that?
he likes to talk a whole lot about super intelligence.
Oh, okay.
And
he's one of those guys.
Yes.
Okay. All right.
See, he and Elon Musk have a lot in common then.
Yeah, sure.
Yeah. But I think one of the things I got most out of this was just sort of seeing how he works, how not just how his mind works, but how he works in the company, how he runs the company, how he's just like spends his time in Slack and does these one-on-one meetings. And it's just like to understand how somebody like that kind of keeps a pulse on a million moving things at once was pretty fascinating.
All right, Mark Milian of Bloomberg Business Week, thank you so much. And be sure to catch this full-on interview with Sam Altman, the CEO of OpenAI, in Bloomberg Business Week. Coming up on the program, we're going to speak with the CEO of the Port of Long Beach, Mario Cordero. Remember the strike that happened for 3 days in October?
Yeah.
It may be back.
Yeah, absolutely. Up against a deadline to next week. The talks start tomorrow. Of course, this is primarily affecting 36 ports on the East Coast, though, of course, the ripple effects could go all the way out west.
This is The Close on Bloomberg. U.S. dock workers and their employers, the port operators, are set to resume labor talks tomorrow. Now, a failure to reach a deal by mid-January could lead to labor disruptions at U.S. ports along the eastern and Gulf coasts. Joining us now to discuss all of this is Mario Cordero. He is Chief Executive Officer at the Port of Long Beach, which is the second busiest U.S. port. Based in California, it is not affected by these potential strikes, but certainly will feel the impact if there is any kind of work stoppage. Mario, thank you so much for joining us today.
Well, thank you for the kind invitation, Scarlett.
So I understand that when you look at the numbers for 2024, you saw a very busy end of the year. And a large part of that, I'm guessing, is due to businesses, merchants rerouting their shipments to the West Coast in case there was any kind of strike in the East Coast or Gulf Coast ports. How much of that rerouting do you think is permanent versus temporary?
Well, I think history will tell you that some of that is temporary, particularly anytime you have these labor discussions every 6 years. So for us, we've benefited in terms of increased cargo year to year. Right now, we're estimating a 17% increase for 2024 with regard to TEUs as opposed to 2023. Part of that has been the surprising consumer spending, but admittedly, some of that is the diversion of cargo from the East and the Gulf Coast ports.
And when you look at what's ahead in the coming weeks and months, are you seeing an increase in rerouting to the West Coast ports because of the concern that these discussions may not be able to be wrapped up in time to prevent a strike?
That's correct. Shippers do not like to be in a situation of uncertainty. So many of them are exercising that option to come to the West Coast because of the uncertainty of the labor negotiations.
I am curious, though, Mario. We talk about this idea of what the unions, the longshoremen on the East Coast have been asking for. And a lot of it is focused around the same things that we saw in the previous port strikes, the concerns about automation and replacing jobs. And they're specifically talking about the big cranes that are kind of now just iconic imagery at most U.S. ports and, for that matter, international ports. Is there any sort of sense here that in those negotiations we would see any sort of meaningful rollback of use of those rail cranes, which they seem to be blaming for their loss or lack of job growth over the last couple of decades?
Well, certainly the subject of automation has been a controversy for, some years now, negotiation after negotiation, whether it's in the West Coast or the East Coast. So this is going to be an ongoing conversation. And again, I'm going to defer to the parties to come to a mutual agreement because, in my opinion, the sooner they come to an agreement, the better for the national supply chain to avoid any disruption in any region.
On that same question, though, Mario, and I'm going to rephrase it a little bit differently here. What can improve efficiency at the ports from this point forward? Is it just increased automation? Because the union is saying, well, there are things like, just better call logging of data coming in and sharing that data with other ports. And then they also talk about maybe using cranes that can, pick up 2 containers at a time rather than 1.
I think it's all of the above. For the Port of Long Beach, we have shown that if we focus on transformation of how we operate by extending hours, by thinking outside the box in terms of how we move cargo more efficient with velocity, I think those are areas where a standard form of operation of a cargo terminal produces that productivity. So As to automation, I think the jury's still out as to whether or not automation simply solves that issue. We definitely know that it reduces costs. But I think, again, I think there are things that can be done to further productivity. And from a Port Authority perspective, I think that's the metric that's very important to us. Moving the cargo, furthering productivity. And I think at this point, I think those are the issues that are going to be talking about at the negotiating table.
So the dock workers did go on strike for just a couple of days back in October before they came to an interim agreement. And of course, a lot of that was pressured by this idea that they wanted to avoid anything political before the election in November. What's your understanding, based on what you've heard, what your peers tell you, of how their stance, each side's stance, has evolved since then, since early October?
Well, the first part of it, fortunately, there was consensus and agreement with regard to wages and other aspects. I think the most difficult issue right now is the issue of technology, more specifically automation. So I think we've heard that President-elect Trump has indicated his view of things regarding the fact that how we need to protect jobs. And I think this is going to be something that's going to be a very substantive conversation. And I think, again, bottom line is, I think the parties have to come to some kind of compromise in terms of how you move or amplify technology and at the same time mitigate loss of jobs. So I think that's the bottom line with the union. And I think in this age of the moving towards the fifth industrial revolution of technology, that's going to be a focal point. And we'll see what the parties agree to or not agree to. But again, hopefully from my perspective, they come to a mutual agreement with regard to these very difficult issues that have been ongoing debate no matter what region of the country you're talking about.
Do the contracts that you have with your dock workers right now, are they applicable? Are they transferable? Do you see them as a model for what could be achieved on the East Coast and Gulf Coast?
Well, I think for the Port of Long Beach, number one, we weren't a party at the table between the management and the dock workers. But as a Port Authority, what we have done is we move forward with a compromise in a way that we move forward to take advantage of the most forward-looking technology, and on the other hand, to make sure that as much as possible, some of these cargo handling equipment remain humanly operated. So I think that's a focal point that we've taken here at the Port of Long Beach. And last, the other aspect, anytime we move forward for redevelopment, we ask those parties that intend to expand or redevelop the terminals to come to an agreement with the union before they come to the port, so that we all together we can move forward and be on the same page in terms of the kind of development that's going to not only further technology, further productivity, but at the same time mitigate job loss. And I think that's the place that we all need to be.
I am curious just too on that point of automation, because there's been a lot of talk about kind of how you see much more of the automation, at least fixed automation in Chinese ports and ports overseas. But people are also quick to point out that those are export nations and kind of, they have much more of a fixed flow of goods. Meanwhile, the flow of goods coming in and out of the U.S. is a lot more variable, which I guess in theory means that you need a little bit more human intervention. How variable is that flow of goods, at least in your port that you're aware of?
Well, that's a very good distinction, Romaine. I think that's one of the distinctions we have here, particularly here at the San Pedro Bay complex, the nation's largest container complex. So on that note, again, from our perspective, I think that's the important aspect in terms of what we receive cargo here. A major import facility and a major export facility. In other words, we're not a transloading or transshipment type of port authority like some of the Asian ports are. So on that, and then keep this everything into perspective. You look at maybe the top 1,000 or more terminals in the world. When you look at that number, only 4% are automated. Admittedly, that number is getting larger year by year. But on the other hand, again, from our perspective here, what we're focusing is productivity. And how do we get the container in numbers out of the terminal and on down to the supply chain?
All right, Mario, we always appreciate you taking time for us. Mario Cordero, he's the Chief Executive Officer at the Port of Long Beach out there in California. We are focused in on that potential dock workers strike. Of course, dock workers on the East Coast, 36 ports, went on strike back in October. That ended after 3 days with the resumption of talks scheduled for tomorrow and a deadline to avert another strike on January 15th, which is about a week, I believe, from tomorrow. Scarlett.
All right, let's just close out on how markets finished the day, because we did have a big rally in equities that kind of faded in the afternoon, with the S&P 500 still closing higher for a second day, but up by only 0.5% as opposed to better than 1% earlier. But big tech was once again the leader. Nvidia, of course, the best performer among the Mag 7 names, with Jensen Huang due to speak tonight. There's a lot of supply in the Treasury market remain. The 30-year yield hit 4.86%, the highest since late 2023.
Yeah, the yield story is going to be a big part of the equity story this year. It was kind of interesting to see the latest note by Mike Wilson kind of hitting at this idea here, those negative correlations now, kind of creating a little bit of a danger zone, at least given how lopsided the equity trade is right now.
And look at that, the dollar is weaker for a change, and that hasn't been the case for 2024, but losing ground by 0.6%. This is the close on Bloomberg.
I intend to resign as party leader, as prime minister, after the party selects its next leader through a robust, nationwide, competitive process. Last night, I asked the president of the Liberal Party to begin that process.
Justin Trudeau, the Prime Minister of Canada, saying that he will step down after 9 years on the job, the longest-serving leader of a G7 nation, done in by his own party. Bloomberg's Brian Platt covers Canada's government for us. He joins us now to talk a little bit more about what's next. This was kind of a long time in the making. He's finally stepping aside. It sets the stage for a new leader of this Liberal Party, though, quick to remind our viewers here, there will be an election shortly after that that likely will shepherd in the Conservative Party as a leader of that Canadian nation. Who is going to be leading this nation, Brian, once we get to maybe the middle of this year?
Well, I mean, the next few weeks and months are going to be very interesting and dramatic and unpredictable. There's a really tight timeline on finding a new leader for the Liberal Party. You would normally have a Liberal leadership race take place maybe as long as a year, 8 months, 10 months, something like that. This one's going to have to be 2 months, because by the end of March, Parliament comes back and there will be votes right away that could trigger an election. And so we very well may get a Liberal leader elected in about 2 months, and then very quickly be into a national election that could see, as you indicated, a change of party over to the Conservatives.
Right. The Liberal Party is not polling very well at the moment, while the Conservative Party has picked up a lot of support. We know that, and as Romaine mentioned, there was a lot of pressure on Justin Trudeau to step down for a while. He's been unpopular for a bit, but it wasn't until Chrystia Freeland, who was his deputy prime minister and the finance minister, resigned in a shocking way that really turned the tide against him. Do we presume that she is running to fill this leadership position?
I think it's very likely that she will put her name in the hat. I don't know how else to read her resignation other than preparing for that possibility, because she could have quit quietly, right? She could have gone away without causing too much trouble. She quit in a very public way and criticized Trudeau on the way down, and I think tried to get some distance from him. So I don't know 100% that she's running, but I think she is very much somebody to keep an eye on here, because she is really the reason why we're in this position now.
Absolutely. And I'm curious. I mean, Canada, obviously not the biggest economy, but certainly strategically important for the U.S. and for a lot of other countries as well. Just explain to our viewers why exactly they turned on Trudeau. I mean, 9-10 years ago, we were kind of heralding this guy as kind of, that next breed of leaders who were going to shepherd these countries to whatever sort of greatness they were. Something really transpired over the last 2 or 3 years to shift the sentiment in such a way that we are where we are today.
Well, Trudeau gets credited with bringing the Liberal Party out of the wilderness. They were not just in opposition before he became leader. They were in third place. Like, they were really far behind, and he brought them all the way back to form a big majority government. And, he's never really recovered from some of the controversies around the COVID pandemic. And I think, there was the biggest issue, I think, that brought down Trudeau's government is they lost control of the immigration file. Way too many people came into the country after the pandemic, and the housing costs got out of control, and people here felt like they could not afford a home anymore. I think if you look at any one factor that killed Trudeau's popularity, the soaring cost of housing really, really badly hurt his government, and he's never been able to recover.
Yeah, inflation does another incumbent leader in once again. Very quickly, Brian, Mark Carney, who was the Bank of Canada governor, also led the Bank of England. He is kind of rumored to be in the running as well for Liberal Party leader.
I've been told by some people with knowledge of his thinking that he intends to run. As long as there's an open vote for the party, it's not tilted towards, say, just selecting somebody who's already in cabinet. If there's a truly open vote for the party, I believe, based on my information, that Carney will run. And so it will be, he's long been rumored as a potential to enter cabinet. Trudeau tried to recruit him as finance minister multiple times. So it'll be very interesting if Carney now makes the jump into politics.
All right. Thank you so much. Brian Platt, Bloomberg News reporter in Ottawa. And just full disclosure, Mark Carney is also the chairman of Bloomberg Inc. Let's turn now to the U.S. because Congress certifying Donald Trump's election victory today. That happened. The certification process was marked by a lot of extra security measures due to the insurrection that occurred at the U.S. Capitol 4 years ago. Our next guest writes, the nation needs to remember the facts of the violent insurrection 4 years ago, despite the president-elect's attempts to rewrite history. Joining us now is Bloomberg Opinion's Timothy O'Brien. Tim, not only just rewriting what happened, but calling or recasting January 6th as a day of love. Yeah. Is anyone buying that?
Well, I mean, I think clearly Trump's supporters buy it. I think Trump himself finds it a useful way to whitewash what occurred that day, but it was indisputably a violent day. 140 police officers were assaulted. One rioter was shot. The Capitol was breached. Legislators of both parties fled the Capitol for safety. And it was a raw effort to overturn the certification that day, which notably didn't happen today, thank goodness.
Yeah.
And I think the reason is I think it's part of Donald Trump's effort to recast history, which he has done constantly throughout his career. And he's good at it. Well, he's good at reframing how he's perceived.
But let me stop you there. Why is he the one that gets to recast history? Because we're talking a lot about this idea that when the Biden administration came in and the appointment of Merrick Garland and the special counsel, the idea that we were going to have a meaningful investigation into this and maybe potentially consequences. I know there are quite a few people in jail for this, though from what we can know now, no one who really led the charge, i.e. the man we're looking at on the screen here. Is that reflective of Donald Trump and the Republican Party, or is that more reflective of the failures of the Democratic Party?
Well, do you mean the party in terms of how the Democrats, in terms of how it was prosecuted?
Yes.
Well, I think Merrick Garland took his time. 1,250 people or so have been convicted of a myriad number of crimes that occurred at the Capitol.
But these are like low-level people. This is like you and me.
Well, I mean, I think it was a classic prosecutorial strategy where you start low and you move up the food chain. I think he's been criticized as a prosecutor, not as a Democrat, for going too slowly.
Yeah, and he's not a Democrat, we should point out.
Right. Yeah. And notably, by the way, on the other side of the ledger at the FBI has always been run by Republicans. It's never been run by a Democrat. So the idea that these agencies are overtly politicized flies in the face, I think, of some of the standards we've had of just around law enforcement and the justice system. I do think Garland moved too slowly, but a lot of other things happened as well. The Supreme Court ruled that presidents are immune from criminal prosecutions while in office. And then Trump won the election. Yeah. And it's a standing rule of the Justice Department not to prosecute a sitting president. So all of these events sort of conspired to keep the target on lower level people who were involved in January 6th and not on Trump himself.
So the DOJ has dropped this prosecution of Donald Trump. The incoming president has vowed to pardon the people who are convicted of the January 6th crimes, the ones that Romain was referring to, once he takes office. Are there any outstanding legal efforts to hold accountable those who did participate in the January 6th insurrection?
There's a state prosecution in Georgia, but as you'll remember, the district attorney, the Fulton County District Attorney, Fani Willis, has been disqualified from that case. So I think that could end up hung up. It's also a state prosecution. It's not clear that the penalties would be as severe.
But you can't pardon anyone who's convicted of state crimes.
Correct. That's correct. And then, of course, the other federal investigation that was in motion was the Mar-a-Lago classified documents case. That's also been punted. So I think for all intents and purposes on those cases related to Trump's time in office, I don't think he's at risk from those. He is going to get sentenced on Friday for the New York criminal case, and he could be the first person to sit in the White House who's a convicted felon if that sentencing goes through on Friday.
And it's widely expected, though, that sentence will likely not obviously be any sort of jail time or some kind
Yeah,
of
the judge has already signaled that he
Yeah.
doesn't intend to impose any kind of prison time.
I am curious, and this is a broader question just about politics in Washington now, and you kind of referred to the fact that we had a certification today that did not involve the violence that we saw 4 years ago, and there's probably a reason by it, because the people who were violent 4 years ago won this time. At least that's the belief. To see the optics of Kamala Harris, who was defeated soundly in the election, standing next to Mike Johnson and having to do her duty as a vice president and do it in a way that did not sort of delve into politics. She was not, and her and Biden were not afforded that 4 years ago. And when we look at Merrick Garland and we look at some of the other folks in this administration that some people say failed to do their job or do enough of their job in going after this, do we need to start talking about the idea that you have two parties operating on two completely different wavelengths when it comes to what norms and decorums we should be following?
Well, I think that's absolutely true, and I don't think it's ideological or partisan per se. I think the Republican Party is now Donald Trump's party, and part of that involves breaking the rules. It involves the idea that the president is above the rule of law, and that the acquisition of power allows for other abuses. And I don't think either party should accept that, and I don't think it's what we want out of good government. And I think Harris standing at the Capitol today, certifying the vote, standing up while she did so, with a Republican speaker next to her, because that's what the process demands, is the way we want our government to run.
Absolutely, and it's kind of interesting too. We're going to have to sort of replay this in about a week and a half's time with the inauguration and see whether that, I guess, show of unity continues through January 20th. Tim O'Brien, one of our columnists here at Bloomberg Opinion, helping us wrap up our coverage here on the day. We are going to just set you up for some of the market moving events over the next 24 hours when we come back after the break, so stick with us. This is Bloomberg. As we wrap up today here, let's push ahead to what the markets are going to have their eye on over the next 24 hours. And we're going to start this evening when we're expected to hear from Jensen Huang, the CEO of Nvidia.
The CEO, the co-founder of Nvidia, 9:30 p.m. Eastern time. And of course, that'll be followed up with a one-on-one interview with Ed Ludlow tomorrow at 11:30 a.m. on Bloomberg Technology.
All right, full coverage right here on Bloomberg. Definitely tune in for that tonight, as well as the interview tomorrow. Back in the morning over in the Eurozone, we are expected to get CPI and unemployment data.
And of course, the ECB is set to cut rates a lot faster than the Federal Reserve is. We're looking at an expected 2.4% increase year over year. Core will increase by 2.7%.
Let's bring it back to the U.S. Richmond Fed President Tom Barkin scheduled to speak at 8 a.m. Eastern time, and at 8:30 a.m. Eastern time, we're going to get a few key data points.
Yeah, we have JOLTS, the job opening labor turnover survey, as well as ISM services at 10 a.m. And all of it is a drumbeat to the big jobs report on Friday.
And don't forget that dock worker labor talks are set to resume tomorrow as well. We'll have full coverage of all that and everything else that moves the markets right here on The Close. Balance of power for all your political coverage coming up next.